If you have a traditional IRA, a massive shift in the tax code is quietly counting down, and you only have until 2028 to protect your life savings from what the IRS is about to do. Millions of retirees are sitting on a tax time bomb, assuming their taxes will go down in retirement. But because of a specific legal sunsetting provision, your taxes are virtually guaranteed to skyrocket. There is a legal, mathematical loophole to shield your wealth, but the runway to use it is vanishing, and once that window slams shut, the damage to your retirement income will be irreversible. You have spent 40 or maybe 50 years working, saving, and sacrificing to build your nest egg. You did everything the financial industry told you to do. You contributed to your 401k, you rolled it over into a traditional IRA, and you took the tax deduction up front. But what you were not told is that by deferring those taxes, you effectively went into a silent partnership with the government. And now, the government is getting ready to change the terms of that partnership. My goal today is to give you the exact blueprint to take back control of your money. We're going to walk through the looming tax changes, the hidden penalties that could drain your accounts, and the precise, step-by-step strategy you must implement over the next few years to disinherit the IRS. Let us start with the single biggest threat to your retirement accounts right now, which is the illusion of the low tax bracket. For the last several years, we have been living in a historically low tax environment due to the Tax Cuts and Jobs Act. But those historically low rates are written into law with an expiration date. They are scheduled to sunset, meaning that tax rates will automatically revert to their previous, much higher levels. The brackets will compress, meaning you will hit higher tax rates at much lower income levels. But the urgency of the 2028 deadline is not just about the sunsetting tax cuts. It is about the mathematical runway you need to move your money before you are trapped by the government's mandatory withdrawal rules. You see, the money in your traditional IRA is not truly yours. It is tax deferred, which means you have not paid a single penny of income tax on the principal or the growth. The IRS has been very patient, letting that account compound year after year. But their patience has a strict limit, and that limit is called the required minimum distribution, or RMD. The government will eventually force you to pull a percentage of that money out every single year, whether you need it to live on or not. And every dollar you are forced to withdraw is taxed as ordinary income. Here is the trap that catches so many hardworking retirees off guard. Let us say you have been frugal. You have lived beneath your means, and you do not need to pull much money from your IRA in your early retirement years. You might think you are being smart by leaving the money alone to grow. But if you have a sizable traditional IRA, that money is doubling every 7 to 10 years. By the time you hit your RMD age, your account balance could be massive. The IRS will then calculate your forced withdrawal based on that massive balance. Suddenly, you are forced to take out tens of thousands of dollars a year. This forced income gets piled on top of your Social Security, your pension, and any other income you have. In an instant, you are catapulted into a massive tax bracket, paying significantly more in taxes than you ever did while you were working. Did you know that up to 85% of your Social Security benefits can become taxable depending on your other income? That is right. The forced withdrawals from your traditional IRA will artificially inflate your income, which then triggers taxes on your Social Security benefits. It is a domino effect. You thought you were in a low tax bracket, but the RMDs push you up, the higher bracket takes a bigger bite, and then your Social Security is taxed on top of that. This is the exact scenario the government is counting on, and it is the exact scenario you must dismantle before the 2028 window closes. But the tax trap goes even deeper, and it gets much more personal. We need to talk about one of the most heartbreaking financial realities in retirement, something known as the widow's penalty. It is difficult to think about, but statistically, one spouse will outlive the other. When you are married, you file your taxes jointly, which means you get to take advantage of the most generous tax brackets and the highest standard deduction. You can have a fairly high income and still stay in a relatively low tax bracket. However, the moment one spouse passes away, everything changes. In the year following the death of a spouse, the surviving widow or widower must begin filing their taxes as a single filer. What happens to the tax brackets for a single filer? They are cut in half. The income threshold to hit the higher tax brackets is drastically reduced, But here is the tragic irony. Even though the surviving spouse is now filing as single, their income rarely drops by half. The surviving spouse usually inherits all of the IRA assets. Therefore, the required minimum distributions remain exactly the same. The surviving spouse might lose one Social Security check, but they keep the larger of the two. So their income remains very high, but their tax bracket is suddenly slashed in half. The result is devastating. The surviving spouse is instantly pushed into a brutally high tax bracket, paying drastically more in taxes on the exact same IRA money. This is the widow's penalty. If you leave all your wealth in a traditional IRA, you are leaving your spouse a tax nightmare. You are ensuring that when they are grieving and when they are navigating the hardest transition of their life, the IRS will step in and take a massive, disproportionate share of the money you meant for their security. Protecting your spouse from the widow's penalty is perhaps the most urgent reason you must act now to restructure where your money is held. And as if the income taxes and the widow's penalty were not enough, there is another stealth tax lurking in the shadows of your traditional IRA, and it targets your health care. Have you ever heard of IRMAA? It stands for the Income-Related Monthly Adjustment Amount. It is essentially a hidden tax on your Medicare Part B and Part D premiums. Most people assume that Medicare costs the same for everyone, but that is simply not true. Your Medicare premiums are directly tied to your modified adjusted gross income. When those RMDs force you to take money out of your traditional IRA, that money counts toward your income. If that forced withdrawal pushes your income even $1 over the IRMAA threshold, your Medicare premiums will skyrocket. And this is not a marginal tax where you only pay more on the amount over the limit. It is a cliff penalty. One extra dollar of income from your IRA can cost you thousands of dollars in additional Medicare premiums for the year. The government uses your traditional IRA as a lever to increase your taxes and increase your healthcare costs simultaneously. By now, you are probably feeling the weight of this situation. The sunsetting tax laws, the forced RMDs, the taxation of Social Security, the widow's penalty, and the Medicare IRMAA surcharges all form a perfect storm designed to separate you from your savings. But I want you to know that you are not powerless. There is a solution, and that is what we are going to focus on next. However, before I reveal the mathematical strategy to neutralize these threats, I need you to mentally prepare for the final reality we will discuss today. Later in this presentation, I am going to explain how your traditional IRA could entirely ruin your children's financial future due to a deeply misunderstood law passed in 2019. It is the most counterintuitive part of retirement planning, and you cannot afford to miss it. But first, let us fix your immediate tax problem. The absolute most effective tool you have to disarm the traditional IRA tax bomb is the Roth conversion. A Roth conversion is a deliberate strategic maneuver where you choose to move money from your tax-deferred traditional IRA into a tax-free Roth IRA. When you make this transfer, you must pay income tax on the amount you move in the year you move it. But once that money is inside the Roth IRA, the magic begins. Inside a Roth IRA, your money grows completely tax-free. When you take the money out in retirement, it is tax-free. It does not count as income. It does not cause your Social Security to be taxed. It does not trigger Medicare IRMAA surcharges. It protects your surviving spouse from the widow's penalty because the withdrawals do not push them into higher tax brackets. And perhaps most importantly, Roth IRAs do not have required minimum distributions during your lifetime. The IRS cannot force you to withdraw your own money. You are in complete control. But here is where the 2028 deadline becomes the absolute focal point of your retirement survival. You cannot just convert your entire traditional IRA to a Roth IRA all at once. If you have $500,000 or $1 million in a traditional IRA and you convert it all in 1 year, you will add $1 million to your taxable income for that year. You will be pushed into the absolute highest tax bracket, losing nearly 40% of your wealth to the federal government instantly, not to mention state taxes. That would be financial suicide. The secret to winning this game is something called a multi-year Roth conversion ladder. Instead of converting everything at once, you convert small, calculated chunks of your traditional IRA every single year. The goal is to move as much money as possible into the Roth IRA while staying within the lower tax brackets. You look at your current income, you look at the top of the 22% or 24% tax bracket, and you convert just enough money to fill up that lower bracket without spilling over into the higher brackets. You pay the tax now at a known, historically low rate to permanently insulate that money from the higher, unknown tax rates of the future. But mathematics requires time. A proper Roth conversion ladder takes years to execute efficiently. If you have a large traditional IRA, you might need 5, 7, or 10 years to slowly bleed that account down to zero without triggering catastrophic tax bills. This is why the window is closing. If the tax brackets compress and rates go up in the coming years, the cost of doing these conversions will become significantly more painful. By 2028, the runway to move large sums of money at favorable rates will be severely shortened, especially as you draw closer to your own RMD age. Every year you wait is a year of tax-deferred growth that you will eventually have to pay taxes on at a higher rate. You are running out of low-tax years to spread the conversions across. The strategy requires you to pay the toll booth now, deliberately and in controlled amounts, rather than being forced through the toll booth later when the prices have doubled and you have no choice. Let us look at a practical example. Imagine you are retired and your living expenses are covered by Social Security and a small pension. You have a gap of roughly $50,000 until you hit the top of the 24% tax bracket. If you do nothing, your IRA continues to grow, and eventually, the RMDs will force you to take out $80,000 a year, pushing you into a higher bracket and triggering all those secondary taxes. But if you take action now, you can voluntarily convert $50,000 this year, pay the 24% tax, and move it to the Roth. Next year, you do it again. The year after, you do it again. You are systematically draining the swamp before the alligators get hungry. It takes discipline to write a check to the IRS voluntarily. It goes against human nature to pay a tax before you absolutely have to. But you must shift your mindset. You are not losing money. You are buying out the government's partnership in your retirement at a discount. You are buying permanent tax immunity. Now, I promise to tell you about the final, most dangerous threat to your legacy. This is the absolute most critical concept for anyone who intends to leave money to their children or grandchildren. For decades, the traditional IRA was a fantastic wealth transfer vehicle. There was a rule known as the stretch IRA. If you passed away and left a traditional IRA to your children, they could stretch the required minimum distributions over their entire lifetime. They could take out tiny amounts every year, allowing the bulk of the money to continue growing tax-deferred for decades. It was a beautiful system. In 2019, Congress passed the Secure Act, and they quietly killed the stretch IRA. It was completely eliminated for non-spouse beneficiaries. Under the new rules, if you leave a traditional IRA to your children, they must completely empty the account within 10 years of your death. They do not get to stretch it over their lifetime. They have a strict 10-year countdown clock to withdraw every single penny. Think about the mathematical devastation of this rule. When are you most likely to pass away? Probably in your 80s or 90s. How old will your children be? They will likely be in their 50s or early 60s. These are their peak earning years. They are likely at the height of their careers, making the most money they have ever made, and sitting in the highest tax brackets of their lives. Suddenly, they inherit your massive traditional IRA. The government mandates that they must pull all of that money out and add it to their already high income over the next 10 years. If you leave your son or daughter a $1 million traditional IRA, they have to take out roughly $100,000 a year, or perhaps wait and take a massive lump sum at the end of the 10 years. Either way, that forced income is piled on top of their peak career salary. It will push them into the highest possible federal and state tax brackets. The IRS could easily confiscate 40 to 50% of your life's work before your children ever get to spend it. The government essentially created a system to trap generational wealth and redirect it to the Treasury. You spent your whole life saving that money to bless your family, but because it was left in a tax-deferred wrapper, you ended up funding the government instead. This is the ultimate payoff of the Roth conversion strategy. When you pay the tax now at your lower managed rates and move that money into a Roth IRA, you change the destiny of your family's wealth. If your children inherit a Roth IRA, the 10-year rule still applies. They still have to empty the account within 10 years. But because it is a Roth IRA, every single withdrawal they make is 100% tax-free. It does not matter if they are in their peak earning years. It does not matter how high their salary is. They will not pay a single dime of income tax on your inheritance. You take the burden off their shoulders. You pay a little tax today so that your children are not devastated by massive taxes tomorrow. You give them a true, unburdened legacy. To summarize the reality you are facing, the clock is ticking on a system designed to extract maximum taxation from your savings. First, you must recognize that tax deferred simply means tax delayed, and the looming expiration of the current tax cuts guarantees a heavier burden if you wait. Second, required minimum distributions are a forced income trap that will inflate your tax bracket, trigger taxes on your Social Security, and skyrocket your Medicare premiums. Third, you must protect your spouse from the widow's penalty by ensuring your assets do not force them into higher single-filer brackets. Finally, the Secure Act has turned the traditional IRA into a toxic asset to leave to your children, making Roth conversions the absolute best defense mechanism you have. You have worked entirely too hard to let outdated tax strategies drain your life savings. The transition from accumulation to distribution requires an entirely different playbook. I want to know where you stand right now. Please go down to the comments and tell me, are you currently doing Roth conversions, or has the fear of paying taxes up front kept you frozen in a traditional IRA? Share your experience, because your situation might just help someone else realize they are not alone in figuring this out.